And let's welcome in Tom Vosa, Head of Market Economics at NAB Capital. Tom, hi, afternoon. How do you think the markets are going to read, or rather behave, ahead of the crucial meeting today between the European finance ministers to discuss the new budget rules? And what do you think is really going to come out of this big meeting?
I think to start with, the markets are still trying to wait for any kind of an agreement on the Greek debt swap. There had been expectations that a deal would have been finalised over the weekend. That clearly hasn't happened. We know there'll be a teleconference today between the debt holders and the Greek government. But I think at the moment, we're running out of time. Greece has a repayment to make on March the 20th. The hope was that a debt swap would be finished by the end of January so that the reductions could go through in time. And I think that's the thing that's really overhanging the markets, because, again, it means when the EU finance ministers meet in Brussels, we can forget the prepared agenda. Then the ongoing discussion will be, can we get a Greek debt swap agreement out of the way? We need that to start moving on through the sovereign debt crisis. I think that's where the nervousness comes from. It's also, of course, a day in which we don't have much in the way of frontline data. We only really have Eurozone consumer confidence. This is the advanced index for January, will be released this afternoon. And that comes after the Germans do a bond auction, or treasury bill auction at 10 o'clock, and the French are doing it at about 2:15. So there's plenty at the moment of concern. We're pretty sure that the German treasury auction gets away. How, of course, will the French auction get away? Now it's a double A name rather than a treble A. So I think there's a little bit of nervousness around that. But in reality, it's a lack of data to get the market to get anything to concentrate on. So what instead they're looking at is a lack of agreement on Greece.
Right. Tom, just to pick up for where you just left, with the deal not there in place yet as far as Greek debt is concerned, do you think the markets are already beginning to price in the possibility of a default?
Well, I think I think the possibility of a default for Greece is 100%. We know there's going to be a default of some sort. The question is it voluntary or is it involuntary, and therefore does it trigger CDS? We started off with a 30% haircut. The agreement was on 50. The latest story is they're now looking for around a 70% haircut for the private sector initiative, which probably is more in line with the sort of debt reduction you need to see to get Greek debt dynamics back on the road to recovery. Certainly, even with 50%, the debt-to-GDP ratios were just too high. I think that's why we've seen these holdouts, because the goalposts keep changing here. What the private sector think they agree to, well, we get lower Greek growth forecasts, and therefore they have to write off a bit more debt. I still think there will be some agreement. Obviously, we're talking about technical levels now, such as what's the value of the coupon and how long are the maturity. But certainly there will be a Greek default. We know that. The question is it voluntary or involuntary? Voluntary one was perhaps always on the cards. I think the risk now is it becomes involuntary.
Right.
And that drags in the ECB.
All right, Tom.